Alright guys, so let's go on to the next section, which is how do you automate your trading process with the right orders. So in this section, I'm going to show you how do you place your buy orders, your stop loss orders, your take profit orders, your sell orders in a way that automates the process. So you don't have to be there physically and to press the button when the prices are in your favor, right? And the reason is this, because when you automate the trading process and the broker buys and sells for you based on your instructions, it takes out your emotions from the trading process. And that's really, really important. See, many people, they say, okay, I will sell it when it reaches that level. But you know what? When it reaches that level, they won't sell it because they get emotional. They'll get greedy and say it could go higher. Or they say, you know what, if I sell it now, it's going to lose money. What if it bounces back? And trust me, if you attempt to do that, you're not going to succeed, right? So I find the best thing to do is to let the broker buy and sell it for you at predetermined prices, and you place the orders and you let it run automatically. It also frees up a lot of your time to do other things. So my preference is to use a fire and forget system. Once I place the order, I'm in the market, I don't look at the market until it has reached my target price or my stop loss price, right? And that's how I spend a lot more time doing other things. I free my emotions from the market and I get excellent results. Remember, only when you can trade without emotions and you think statistically, do you optimize your results in trading. So automating orders helps you to do this. So let's take a close look and understand the different kind of orders that we can place with the broker. Okay. So the first kind of order that we can place is known as a market order. So whenever you click the buy or the sell button, you have to specify the kind of order. So if you put in a market order, what it means is that you're instantly executing your buy and sell order at the current market price. So in other words, when you place a buy order at market, you're buying at the ask price. And when you sell at market, you're selling at the bid price. Recall, when you look at your screen, you're going to see two prices. You're going to see the bid price and you're going to see the ask price. Okay. Now the ask price is always higher than the bid price. So for example, if you're looking at the Euro USD, ask price could be 1.2010, okay, and the bid price could be 1.2009. Okay, so what is the difference between the bid and ask price? The difference is 1 pip. That is the difference. We call that the spread, okay, or the slippage. All right. Now, you have to use a broker with very tight spreads of maximum 2 pips. If the spread is too wide, it's going to be really difficult to make money, especially if you're a day trader. So what does this mean again? So the ask price basically is what sellers are wanting to sell at. Okay, so they're asking to sell at 2010. And the bid price is what buyers are willing to buy at. So these are what buyers are willing to buy. They're willing to buy at 2009. Okay, so if you are a buyer, you have to buy it from a seller. Okay, so if I'm buying, I will buy at the ask price. So whatever the seller is asking for, if I want to buy it immediately, I have to buy it at the price he or she is asking for. Okay, so I buy at 2010. Okay, if I'm placing a market order, I buy immediately at 2010. Now, if I want to sell, I have to sell it to a buyer. So what is the price the buyer is willing to buy at? Well, that's the bid, which is 2009. So if I sell it, I'm selling at 2009. So notice that if you buy any currency pair, right, at 2010, for example, and you sell it immediately, what happens? You are immediately losing money. You're losing 1 pip. So that's the cost of entering the market. Okay? So who makes this 1 pip, basically, right? It's the market makers or the market out there where they place the bid and ask orders. Now, when you place a market order, you are guaranteed to get filled. In other words, you're guaranteed to get the currency pair. If you place a buy, you're sure to get your buy order filled. You click a sell, you will get it filled. But the price is not guaranteed. Now, why is the price not guaranteed? Now, remember that when the market is open, which is 24 hours Monday to Friday, the bid and ask prices are moving every second. It's changing rapidly. It keeps changing, right? So if you see ask 2010 and you click buy, you may not get it at 2010 because the moment your order goes into the market, it takes a few seconds. Now, by that time, 2010 may have moved to 2011 or 2012. So you will end up buying at that price. So market orders are more risky because you don't know exactly what price you're going to buy at, but you're guaranteed to get the order. So I rarely use market orders to enter a trade. Okay. Next are what we call limit orders. Okay. Now remember, when you place a market order, you get instant execution. Instantly you buy it, instantly you sell it. When you place a limit order, it is what we call a pending order. So what's a limit order? A limit order is when you want to buy and sell at a specified price, we call it the limit price or better. So when you place a limit order, the price is guaranteed. So whatever price you want to buy at, you will definitely get the price or better. But your order is not guaranteed to be filled. So let me give you an example. So let's imagine that we've got the bid and the ask. Okay, and currently the ask is at 3506. Okay, so that's the current market price. So remember, if I want to buy immediately, I click buy, I would probably get it at 3506 if the market doesn't change. Make sense? Now, if I want to place a limit order, now whenever I place a limit order to buy, it means I want to buy at a certain price or lower. Okay, or lower. So I may put a limit order of, for example, I say, I want to buy at 3505. That is my limit. That's the maximum I will pay. Okay, any lower, I'll take it, but no higher than that, right? So if I place a limit order at 3505, will I get executed immediately? No, because the price is right now at 3506. So the price, the ask price has to go down to 3505 in order for my order to be filled. So I will buy at 3505. Now what happens if the price suddenly drops from 3506 to 3503? Right? Would I end up buying it? Yes, I would. I'll buy it at 3503 because a limit price means I buy at 3505 or lower. Make sense? Great. So that's how a limit order works. Next, if I place a sell limit order, it means I'm selling at a certain price called 3505, okay, or higher. Remember, when you are a seller, you always want to sell as high as possible. So you're saying I want to sell at 3505 or better, which means or higher. But when you're buying, you want to buy as low as possible. So you want to buy at 3505 or lower. Okay? So again, example. Let's imagine right now the bid price is 3505. Okay? So if you want to sell at the market, you would sell at 3505. Or you may say, you know what, I don't want to sell at 3505, I want to sell higher than that. All right? So you place a limit order, or tell you what, let me change this. Let's say this is right now 3504. Okay? So if you want to sell, immediately you sell at 3504. But you say, no, I want to sell higher. I want to sell at 3505. So you place a sell limit order of at 3505. So if you do that, it's a pending order. Would you end up buying at 3505? Not if it stays at 3504. In fact, if it goes down, there's no way you're going to buy it. Only if the price goes from 3504 to 3505 would your order be executed and you buy at 3505. Make sense? Now, what if the price shoots up to 3506? Would you end up selling it? Yes, because you want to sell it at 3505 or higher. So that's how limit orders work. Now, typically, I do not always use limit orders to enter a trade. I may at times, but most often I don't. I use limit orders to take profits. Okay, and later I'll show you exactly when to use limit orders and when to use stop orders, which is what we're going to talk about next. All right, so let's now go to the next kind of order. So we talked about market orders, buying immediately, right? Immediate execution. We talked about limit orders, where we buy lower than the current market price, or we sell higher than the current market price. The third kind of orders are called stop orders. Now, stop orders are also another kind of pending orders. But here's the difference. A stop order is a pending order that converts into a market order when a specified stop price is reached or exceeded. Now, I use stop orders very often, and I use it in two situations. Number one, I use stop orders to enter a trade, and I use stop orders to exit at a loss or as a stop loss price. Okay, so first I'm going to show you how I use it to enter a trade. So, for example, I use a buy stop order to enter a long trade setup. Let me give you an example. And again, in the later lessons, I'll teach you the specific strategy. I'm going to give you an example. So take, for example, this is a moving average, all right? It's like a 50 moving average. And I have got the price, right? The candles are going up like so. Okay, and then the candles come down, and I see a bullish pin like that. Okay, so in other words, the price is going up, it retraces to the 50 moving average. I got a bullish pin. So at this point of time, I'm anticipating that the price will continue in the uptrend. Okay, so currently, where's the price? Currently, the price is right here. This is the price right now. Okay. So I only want to enter if the price moves in my favor, okay, if it continues the trend. So I do not want to buy right now at the market price. If I buy the market price right now, it may not bounce up as I anticipate. It may continue going down. So I will place a buy stop order just above the high of this candle. So let's imagine that the current price is 3501, right? That's the current price right now. Okay, so I would place a buy stop order just above the high. So for example, I could place the buy stop order at 3502. Okay, so what does it mean? It means that if the price goes up as I anticipate and hits this stop price called 3502, it would trigger and convert into a market order and buy it right at that market price, which would hopefully be about 3502 or at the very most 3503, and I'm in the trade. Okay, so again, buy stop orders are used to enter higher than the current market price. And the reason you want to enter higher is you want to catch the trend if it goes in the direction which you want. Make sense? Great. So I use buy stop orders to enter a long trade. Similarly, I use sell stop orders to enter short trades, to go short. So let me give you the other scenario. So let's imagine this is the moving average. Again, it's the 50 moving average. And we've got the price that's doing this coming down, and say the candles are going up like that, and say I've got this bearish pin bar. Okay, so I'm anticipating the price is gonna continue going down, for example, right? So I want to catch to short as it goes down. So say the current price right now is again 3505. That's the current market price. So I do not want to sell immediately at this price because at this point I do not know that it's going to continue going down. I never like to predict the market. I like to catch the market when it goes in my anticipated direction. I like to wait for confirmation. So I'll place a sell stop order below the current price. Current price is 3505. My sell stop order could be 3504, for example. Okay, just below the low of this bearish pin. So in the next candle, if the price continues going down, as I anticipate, goes below the low, what happens? That's why my stop order of 3545 will get triggered and converts into a market order, which means I'll sell right at the market price, which would again hopefully be 3504 or maybe slightly less, or 3503, and I'll catch the trend all the way down. So that's how stop orders work. Oops, let me just go back there again. So again, to reiterate what I said, okay, the current price is here, for example, okay. Buy stop orders, okay, are used when we want to buy higher than the current price to catch the trend as it goes up. So my desired buying point is above where the price is right now, okay. So stop orders are used to enter when there's further confirmation of the price movement in my favor, okay. So again, for buy stop orders, the desired entry price must be higher than the current price. Similarly, when I use a sell stop order, all right, I'm selling below the current price. The desired entry price must be lower than the current price. All right, so that's the first way I use stop orders. The second way I use stop orders is to exit a trade at a loss. So remember that any trade you go in can either be a win or loss. Okay, when it loses, when it's a losing trade, you exit at -1R, right? You take a 1 hour loss, if you recall that, right? So we have to have a stop order to get us out the moment it hits a certain price. So we predetermine our loss before we enter a trade. So it is used to minimize losses if the price moves against you. So once again, if I'm going long, right? If I'm going long, if I'm entering a trade, I expect it to go up, okay, to hit my target price. Now, if it doesn't go up and it goes down to a certain price, I have to get out and take my loss of -1R. So what kind of order do I use to protect myself? That's right. If I'm going long, all right, I use a sell stop order. So in this case, I'm entering at 3230. Okay, taking a long trade. So I place a stop loss, which is a sell stop order at 3210, 20 pips below my entry price. So if the price goes to 3210, what happens? That's right, it's a stop order. It gets converted into a market order and sells for me immediately at 3210 or at the market price at the point of time. So again, I'm not guaranteed to get that price, but I want to get out as soon as possible. And most of the time, you get filled at a very, very close price. So once again, with stop orders, it converts to a market order. Your price is not guaranteed, but we're going to enter and exit close to where it is. Now, similarly, buy stop orders are used for short positions. So if I'm going short, if I'm taking a short trade, I'm entering at 3230. I expect the price to go down and I make money. Now, if it goes up, I have to cut my loss at 1 hour again. So when I'm going short, my stop loss would be a buy stop order at 3240, which is again 10 pips above my entry price. So if it goes to 3240, stop order converts to a market order. It buys for me immediately at 3240 or somewhere there, and I exit at a 1 hour loss. Okay, so that's how stop orders work. All right, so the next thing that you need to do when you place an order is to specify if it is a day order or a GTC order. So a day order is an order that's automatically cancelled at the end of the trading day if the trade is not executed. On the other hand, a GTC or good till cancel order will remain in force until it is executed or cancelled by the trader. So when I place an order, I always place a GTC order, good till cancel, because I want my stop loss and my target price to be there all the way until one of them is hit. Okay, but again, the way that we're going to trade Forex, we're going to use 50-minute candles, and most of the trades are going to end within 2 hours or less, right? So it rarely goes beyond a day, very, very rarely, okay? So let's put everything that we learned together, all right? So whenever we place a trade, we always place a bracket order. A bracket order means 3 orders are placed at the same time. The entry, let me write it down here. The entry order, the stop loss order, or SL, and the profit target, or the target profit, we call it TP, okay? So 3 orders are placed at the same time, and it is known as a bracket order or an OCO. OCO stands for 1 cancels 1. This means that if the target price is hit, it will automatically cancel the stop loss because we are out of the trade with a profit. If the price hits a stop loss, it will automatically cancel the target price. So we exit as a loss. So again, once I place the trade and it's filled, it's a find and forget system. I wait for the price to hit the target price or the stop loss. I don't look at it until it happens. And I make sure that they are GTC orders. So when we're going for a long setup, we enter with a buy stop order at, for example, 3250. And our stop loss would be a sell stop order, which would be, for example, 3240. So my stop loss distance in this particular case would be 10 pips. And again, you must calculate your position size in such a way that that represents only 1% or maximum 3% of your capital. And we call this your 1R distance. We then place a profit target 1.5R above your entry price. So in this case, if we're risking 10 pips, our target price should be 15 pips, 1.5 times the stop loss distance. And your target price is a sell limit order at, for example, 3265. Now, in reality, when you are using most brokers with an MT4 platform, you don't have to worry too much about, is it a limit order, is it a market order, you don't have to worry about it because in most platforms, it is already preset, okay? It's already preset. All you got to do is to key in your entry price, your stop loss price, and your target price. And again, I'll show you on a quick demonstration on the trading platform, right? But you have to understand this of how it works, basically. But in reality, everything is preset for you. So that's a long setup. So an example would be, again, this is a trade where we're going to go long, okay, on 50-minute candles. And you'll be learning the strategy in a couple of lessons down the slides, okay? So here you can see the 6 EMA crossing above the 18 EMA. So we call that a bullish signal. So the moment it crosses, we wait for a swing high and a pullback candle. In this case, it is a bullish pin. So the moment I see that bullish pin, I anticipate that the price is going to go up. Now again, we're going to learn the strategy in a short while, so don't get ahead first, but I'm just showing you how I'm going to place the order. So the moment this candle closes, okay, before this candle starts forming, the moment it closes, what do? I'll place my buy stop order just above the high of this candle. So in this case, just above the high would be 2186, and it's a buy stop order, which means if the next candle goes above or the next candle reaches 2186 or more above the high of this candle, it will convert to a market order and I will enter the trade here. I'll get filled basically, right? At the same time, I'll place a stop loss order, which is a sell stop right below the low of this candle. And in this case, it's 2178. So the difference would be 8 pips. That's my stop loss distance, okay? So I'm risking 8 pips. I must make at least 12 pips. 1:1.5. So my sell order, which is a sell limit, would be 2186 plus 12. That's 2198. So this is how I'll place 3 orders for a long setup. Once again, this is my entry price, E. That's my stop loss, SL, and my target price, TP. That's how I place a long trade setup. Okay, so if I'm taking a short trade, it's the opposite, right? Again, I place a bracket order or an OCO, one cancel one order, where an entry order has a profit target and stop loss attached to it. So in this case, this is my entry. This is my stop loss and my profit target. So I'm going short. I want the price to go down towards my profit target. If it goes up, I have to cut my loss. So once again, my entry will be a sell stop order at 2020, for example. And it could be a day order or good till cancel. Doesn't matter because you would normally get filled within a day. But for your stop loss and your target price, you definitely want it to be a GTC order. They have to be good till cancel. They have to be there to protect you all the way till one of them gets hit. So my stop loss will be a buy stop order, in this case at 2030. So that's 10 pips above my entry. 10 pips. So my risk would be 10 pips. Okay, and again, calculate your position size. This should be no more than 1% risk of your capital, or 3%. So if I'm risking 10, I have to make at least 15 pips to make it worth my while. Risk 1 R to make 1.5 R. Okay, so my target price would be a buy limit order of 2020 minus 15, that's 2005. All right, so that's how I place my orders. So do review the slides till you fully understand the concept. And again, I'm going to show you in a short while how I place trades on a trading platform, where you find that most of these buy stops and buy limits are preset. So you don't have to worry too much about remembering which order to use. All you got to do is just set it in and it does everything for you. So let's take a look at that. So here's the chart example of how I place a short order entry. So in this case, you can see the 6 EMA crossing below the 18 EMA. So there's a clear downtrend pattern. And again, you will learn the strategy in a short while. So relax about the strategy. Just showing you how I place the orders first. And then we'll go into the strategy, right? So 6 crosses below 18, and we've got what we call a swing low pattern, followed by an inside bar. So the moment I see this inside bar, I'm going to anticipate the price is going to go lower. So I'm going to do a short. So I'm going to sell right below the low of this candle. And that happens to be 109.12. So that is my intended entry price, intended sell entry price. So that's my sell stop, 109.12, which means if the next candle goes below the low of this candle to 109.12, it would stop and convert to a market order and sell and bring me down, okay? Or take me into the short trade. And I'll place my stop loss above the high of this candle, somewhere over here, at 109.20, which is 8 pips away. One of the things that I'm going to teach you is that your stop loss should always be at least 8 pips away from your entry price. Okay, so in this case, it's 109.20, so it's 8 pips. And again, my stop loss would be a buy limit of 109.20. So this is my stop loss price. This is my entry price. So this represents my 1R risk distance, okay? So if I'm risking 1R, I must make at least 1.5R. So 8 multiplied by 1.5 would be 12 pips. So I must place my target price 12 pips below the entry price, which will be 109.00. So this is my profit target or my TP, and this would be at 109.00. So there you go. So that's how orders are placed for a short entry. Now, recall earlier I said that I tend to enter the trade using buy stop orders for long and sell stop orders for short. But there are times when I would enter a trade with a limit order. I'll enter a long trade with a buy limit order and enter a short trade with a sell limit order. Now this happens under special circumstances. Let me explain. So first of all, let's recall. We use a buy limit order when we want to enter below the current price. Okay? And we're using a sell limit order when we want to sell higher than the current price. So when do I use these orders instead of my usual buy stop and sell stop orders? Well, I use it when the price has already moved from my intended entry price. It's already moved and I was a bit late. By the time I saw it, it moved away. So I'm hoping it would retrace back and fill me at my intended entry price, which is lower than the current price if I'm going long. So let me explain what I mean. So let's go back to this example. So what's happening is I'm looking at this crossover that is a bullish signal, and the moment I see that, I look for a swing high candle. And again, I'll explain this in detail in the strategy to come. So don't worry too much about the exact strategy, but understand the concept of what orders I use, all right? Okay, so I see that swing high, and after the swing high, I've got what we call a pullback candle, or this bullish pin bar. Now, like I mentioned earlier, the moment this bullish pin bar is formed, I want to enter if the price exceeds the high of the candle. So I place a buy stop order. So recall, a buy stop order means you want to buy higher than the current price. So the next candle, if it goes above the high, it gets triggered, right? So that's what I normally do. But sometimes, you know, by the time I look at it, I look at a chart, I may be a bit late. So maybe by the time I look at it, this candle has already formed and the price is, say, somewhere here. So it is above my intended entry price of 2186. For example, the price may have already moved to 2189, for example. Okay. So if it's already at 2189, it is above my intended entry price. I do not want to jump in at the high. I never want to chase it. It's very dangerous to chase it. So I'm hoping that it will come back, right? It will come back to 2186 where I can enter before it continues going up. And the great thing about Forex is Forex doesn't go up in a straight line. It tends to go up, comes down again, goes up. So there's a lot of volatility. So oftentimes, even if I missed it and the price has moved by a few pips, I could still get in by placing, in this case, I'll place a buy limit order of 2186. So let me repeat, I would only use a buy limit order of 2186 only if the price has moved above 2186. So it's gone to 2187, 2189 or 2190. Okay? So a buy limit means you buy lower than the current market price. So sure enough, you can see that if you had done that, right, the price in fact went up and it came back down, it would have filled and then it continued going up. Okay. Now, having said that, if the price has already moved by more than 7 to 8 pips, I don't intend to enter anymore. I'll just look for another trade. But only if I have missed it by, 2 or 3 or 4 or 5 pips at the most, I would use a buy limit to get in. Hopefully, the price would retrace back. Okay. Now, same goes for a short entry. So again, remember this example? After I see this bearish signal, I see a swing low and I see this green inside bar. So I am intending to enter right below the low of this candle. Okay, so I have a sell stop at 10912. So if the next candle goes below the low, it would trigger the sell order. So again, recall I use a sell stop when I want to sell lower than the current price. Remember that? But again, what if by the time I look at it, the price has already moved? It has already moved past my entry price of 10912. For example, it may have already gone to 109. 1.09, for example. It's already moved 3 pips below my intended entry price. Again, I do not want to chase it. I do not want to sell it at 109.09. So in this case, I'm hoping it will retrace back and I could sell it at my intended entry of 109.12. So in this case, I'll use a sell limit order. So we use a sell limit order when we want to sell higher than the current price. So it's got to go back up to fill at 109.12. Now in this case, did it get there? No, it didn't, right? So notice that once it went down, it kept going down all the way. It never retraced. So my order would not have been filled in this case. And fine, that's it. So I missed the trade. Once it moves by more than 5 to 6 pips, that's it. I cancel the order. I look for another trade. Okay, so that's essentially how I enter with buy limit orders and sell limit orders under those special circumstances. Okay. So with that, let me show you some live demonstrations of how I place orders on a live trading platform. All right, so let me show you an example of how I place a long trade. And as you can see right now, we have got the Euro Aussie dollar. It's on a clear uptrend, making a new high, pulling back, and I'm looking for it to continue the trend. So I'm going to put a buy order right above the high of this candle. Okay, so yeah, right above the high of the candle. So let me just zoom in and let's take a look. Where's the high of this red candle over there? So the high would be somewhere at 5035. 5035. Let me just adjust it over there. There, 5035. And a stop loss we could put at the low of that candle. So stop loss would be at 5018. Okay, so let me just write that down. So I'm going to put a buy order at 5035, stop loss at 5018. So what is the distance between my entry to my stop loss price? 5035 minus 5018, that's 17 pips. Okay, so my target price has to be about 25 pips above, 25 plus 5035. So 5065 is my target price. Okay, so how do I place an order? Well, I'm going to click new order over here. And I can put in the volume. So 1 means 100,000. One contract is 100,000. So you can adjust to the number of contracts. You can also put 0.5, which is 50,000, depending on how you size your positions. Let me do that again. Okay, so I'm gonna enter with a pending order, and I'm gonna use a buy stop order. So I'm gonna buy at 5035, 1.5035. Okay, so that's my entry price. My stop loss, I'll put it at 5018. 1.5018, and my take profit would be at 1.5065. So there you go. Put 3 orders. Your entry price, which is a buy stop loss, take profit. Once you're ready, place the order. Boom. Okay, so our order is placed, and you can see this green line represents the buy order. So the moment it goes above the high, it will get triggered, which it just did, and my stop loss is there. So if it goes up and hits my profit target, I'll make my profit. If it hits my stop loss, I stop out at minus 1R. So as you can see, over here, just entered this trade right now, right? Euro Aussie. We bought 0.5 contracts, so that's 50,000. Bought at this price, 5035. That's my stop loss, 5018. My target price is 5065. Okay, and that's my commission. And currently we are, and you can see the profit and loss is over here, right? So as it goes up, I'll make profit. It goes down, negative, right? And we'll see if it hits the stop loss, or you'll hit the profit target, which is somewhere up there. All right. Again, if you want to look at this, you have to go to View, Terminal. All right. So as you can see, I got rid of it. If I want to view it again, I go to View, Terminal, and there you are. Right. So the terminal will show you the order, the time you placed it, again, your buy stop, number of contracts, right? In this case, I just bought one, okay, at 0.5 contracts, Euro Aussie. Again, the buy price, stop loss, target price, and this is the unrealized profit or loss, okay? So currently, as you can see, it went up, it triggered the buy order, and it came down slightly, so it's still negative, but I'm confident you'll go all the way to the target price, okay? If it hits a stop loss, well, I'll stop out, but I believe it's going to go up because it's on a very clear uptrend. Let's see what happens. Okay, so as you can see, the trade is doing pretty well as of now. The price is right now at 5036. It's above our entry price slightly. So we've got a profit of $33, $32, right? So as it goes up, my profit will go up until it eventually hits the target price. So as you can see, as I zoom out, right, I've got my entry price, my stop loss, and my target price. So to reach the target price, it's going to move here, and you'll hit my profit target. I'll exit with a profit. Again, if it hits my stop loss, I'll exit with a loss. So currently, the price is above the entry price. Like I mentioned, you can zoom in once again, and you can see we've got a nice $40 profit right now, $50 profit, right? So that's how you place a buy order for a trade. All right, so let me show you now how to place a sell order and a bracket order for a short trade. So similarly, what you do is you go to new order. When you're ready to place a trade, click on new order, and you have got the box that comes up. This is your order box. And first thing is you have to select how many units you're going to short. All right, so again, a 1 would be 100,000, right? So one lot is 100,000 units. If you put 2 lots, it's 200,000 units. If you put 0.3, it's 30,000, right? So depending on your position sizing calculator, you put in the appropriate volume, okay? Next, again, very often when I'm going to take a short entry, I use a sell stop order. So I'm going to go to this. Now, market execution means market order, which I do not use. I use instead a pending order, right? So the pending order, and I'm going to choose a sell stop. There we go, okay? So I have to decide what is the price I'm going to enter at. So again, depending on the price action, depending on the strategy, you're going to learn it in the next lesson. Let's imagine I want to sell it at 112.80, for example. So that's my entry price, okay? So I'm going to place a stop loss. Now the stop loss must always be placed above the entry price. So say my stop loss is 10 pips above, it'll be, stop loss would be at 112.90. Okay, so 10 pips above the entry price. So my profit target has to be 15 pips below my entry price, right? So I'm risking 10 pips to make 15 pips. So 11280 minus 15 is 11265. All right, so take profit will be at 11265. There we go, right? So that's your sell entry, that's your stop loss, that's your profit target, that's the volume pending order sell stop. Okay. Again, if you don't click on this, if you don't click on it, it's a good to cancel. So there's no expiry date. Right. So once you're ready, you place the order. Boom. Okay, orders placed. So once you place the order, you can see this green line represents the price you're gonna sell. So the moment it hits the green line, the stop is activated into a market order. You sell at the market. Okay, your stop loss is over there. Once your order is triggered, if it hits the stop loss, right, you are out with a loss. But if it hits your profit target, where's your profit target? You zoom out. There we go. So if you hit your profit target over here, right, you will exit with your maximum profit of 1.5 R. So you can see over here, that's your sell stop, your stop loss, and your target price. There we go. Okay. And if you look at the terminal again, you can see over here, selling 0.5 dollar yen. That's the sell price, stop loss, target price. Okay, and again, this is from the terminal. You can click View, Terminal, right, and you will get this over here. All right, so that's how you place an order for a short trade. All right, so as you can see currently, the price has gone down to 11274, which is going to our target price. It is below the entry price. You can see a nice profit of $21. Right, if it hits over here, we maximize our profit at 1.5 R. Right, so that's how we do it. Right, so that concludes lesson 4. We've covered position sizing, risk management, and how do you automate your trading by placing the right orders. So now that we've covered the fundamentals, we've covered the basics, we're going to go into lesson 5, which is the most exciting lesson, which is learning the first strategy known as the impulse pullback strategy. So I'll see you in lesson 5.